Hi, so for this video, I'm going to be going over Hyperliquid, the basics of Hyperliquid, and just kind of everything you need to know, tutorial, basics, all that kind of stuff. So we're going to start out from the top on the trade page. We're going to start out with Mark, Oracle, 24-hour change, 24 volume, open interest, and funding and countdown. So starting off with Mark price. Mark price is the price that Hyperliquid uses. And then Oracle price is the price that Hyperliquid assumes or calculates off of like Coinbase, Binance, what the market price is. So Hyperliquid's price, market price. Hyperliquid will base your positions, like your liquidation points, off of the market price. And the only time these two really matter specifically is if there's a super big change between them. But that's very rare, and honestly, it doesn't happen that much. Then there's 24-hour change, which is not the change over the current day. It's the change over the past 24 hours, which is important to know. Then 24-hour volume. What is good about knowing the volume? Just the total amount traded in the last 24 hours. I don't know. You can see if there's lots of buyers, lots of, like, if you see if there's like a lot of things happening. Good to look at on more niche assets, because sometimes if you look at a niche asset and it's got very high or very low volume, then it can really affect your funding rate and other stuff based on your trade. Then what is next? There is open interest. For open interest, it's actually really useful because it's the amount of future positions that are currently open, which means that's the amount of shorts versus longs there are. And there's a little comparison you can do with the price and the open interest. So if open interest is up and price is up, that means new traders are entering. Usually suggests a stronger trend. If price is up but open interest is down, price is rising because traders are closing shorts, not necessarily because new buyers are entering. If price is going down and open interest is going up, price is falling while more positions are being opened, often indicates new shorts or increased leverage. Then if price is going down and open interest is going down, positions are usually being closed or liquidated. Yeah. Then another really important, or the last really important thing up here is the funding / countdown rate. Because there's the price that Hype is supposed to be at. And then if everyone hops on Hyperliquid and starts longing it, it's obviously going to move. It's gonna push it up. So what the funding rate will do, and they also never expire, because you have a contract, but they never expire. So it's like futures. So when everybody's going long, the future price is drifting away from the actual market price, and then funding helps pull it back. The countdown here is just, I'm pretty sure it's every hour. And then this is how much you have to pay. So if you look at this position I have down here, the funding rate over, I've had to pay $15 to keep this position open over a while. And yeah. And then there's the amount, the percentage. And if you hover over it, you can see the annual, which is over a year. An easier trick is to just times this by 24 to see what the daily rate is if you're worried about it. Usually it's not too bad, but if you go onto something like, what's a good example? Like, let's look at Samsung. Annualize, that's 40%. So it looks like a lot, but it moves really fast. A lot of changes happen, so you won't have to worry about that as much. So I would only do 24-hour to 1 week to figure out what that is, because it changes incredibly fast. I think this morning was at 130%, and it bounces around. And then any other points? And funding rate is really good because it tells you which side of the market is really crowded. You can see a minus sign next to it when it's negative. So right now, shorts, or no, longs, there's too many longs on Bitcoin right now. So longs pay shorts this amount. So if someone opened, so you see we got Hype over here. I've got a long position open. If someone opened a short position on Hype at the same time for the same amount as me, they would be plus $15 right now. Obviously, they would be down because of this, but because the funding rate is positive. And I don't know if I can find something where it's negative, but if it's negative, then anyone going long will pay shorts. If that you see, here's one negative. So now anyone shorting will have to pay longs because so many people are shorting this. But yeah, so that is a crash course on this top bar. Okay, so for the second part of this video, we are going to look at over here. We have these guys, which here we'll start with these guys up here. So isolated versus cross. Cross will pull money to keep your positions open from your account, from your assets, and even other positions you have open. And then isolated is individually. So I placed this trade with $2,000. I'm only risking $2,000. One time I placed a Cardano long for $100, and it just kept going down and I was on cross. So it pulled from all my other positions and I hit minus 300%. But in isolate, you can only lose how much you put in, which is the ideal. Leverage, how much leverage you're using, you know. I put in a $2,000 position with 5x leverage, so it turns my $2,000 into $4,700. But it's also more riskier. So if it goes up 1%, it goes up 5% for me. But if it goes down 1%, it goes down 5% for me. And if this goes down, if it goes down 20%, 20% with 5x leverage, that's 100%. So I would get liquidated. Unified versus portfolio margin versus manual. Unified is where all your balances have, all your accounts have separate balances and you can move them around in between. I would recommend this one the most. Manual is for usually bots and algorithm trading. So I wouldn't worry too much about that one. Portfolio margin is actually something I've been looking to switch over to because it's really interesting. Instead of using the USD or USDC as collateral and trading margin, you can use Hype or Bitcoin. So in a position where I'm longing Hype, I can long Hype and put down my collateral as Hype. So the money I have in Hype will go up as the position goes up as well. This is especially important if you don't believe in stablecoins or the US economy or the strength of the dollar and you want to risk something else. So this is really good. I'm definitely going to look about switching over to that in the future. Then it says account must be under 25 million to use portfolio margin. I wouldn't worry about that. Then market means you buy it at the mark price up here we talked about. And then there is, you know, you can buy long, sell short, choose your position size. Then there is limit, which it will buy it if it hits a specific price. So let's say I want to buy Bitcoin at 80,000. I'll set a limit order for 80,000. And so I don't have to be on the platform. I can just be eating lunch or whatever. And if it hits 80,000, it will buy it. And you can also do that with shorting it. And then pro, there is, first of all, scale, which scale is total orders, total skew. So you can buy multiple orders over time and split it into different payments. So split it into a lot of smaller orders, like buy a little bit at 60K, buy a little bit more at 59K, and you can choose how much you want to split it up. Then there is a stop limit, which a stop limit is when a price reaches a certain price, place a limit order. So I can say if Bitcoin reaches 70,000, it will definitely reach 80,000. But if it doesn't reach 70,000, it is going to go back down to 60,000. So what I can do is I can say, okay, so if it reached 70,000, place a buy order for 80,000 or whatnot. And then what is next? So a stop market, which is where when price reaches a trigger, buy or sell immediately, which this is what most people use as their stop loss point. It'll instantly buy or instantly sell at the market price. Perfect for stop loss. This is what most people use. Then there is what's next? Take limit. So when it comes to take limit, you take a profit at a specific price using a limit order instead of a market order. So it's the same as a stop limit, except taking profit instead of closing a loss, you know? And then I think after that is take market, where it's the other thing, you know, there's stop limit, stop market, take market, where it's if it hits this specific price, take the money out where it's at. Take it out like immediately once price is reached. Pretty self-explanatory. And then there's a more complicated one that you usually don't have to worry about as much, which is TWAP, which is usually for people running much higher accounts and whales that want to buy large amounts without moving the market. So instead of buying an order of $1 million, they would split it up into 100,000 every few minutes. Not something I have to worry about in the moment, but maybe in the future. And yeah, you can kind of split it out however you want. Then, yeah. So how far long is this video? 15 minutes. I could probably cover off the last bit. Okay, so last bit down here, unified account ratio. This would be how high my risk is of getting liquidated and losing all the money in my account. Again, I'm on isolated, so I'm not doing cross margin, so I'm not risking the money in my account to keep this position open. I'm only risking the money I put in, so that is 0% risk of liquidating my account. Portfolio value, just how much money you have in your portfolio, including your trades. Unrealized P&L, the profit you have in trades that has not been claimed, that have not been closed. Perps maintenance margin, which is the minimum portfolio value required to keep your cross positions open. Oh yeah, that's 0 again because I don't have any margin things open. But if I did, maintenance margin is the minimum amount of collateral you have to keep to avoid liquidation. And then unified, which is your total cross positions value divided by your total collateral balance. So that would be 2,000. And then if this was a cross, if it was cross, so if it was if I was using margin to keep this open in my account, it would divide this by how much is in my account. And so if I had 4,000 in my account, it would be 50%, which is not good. Or I think that's like 2x, which is not good. Which you want, like, if I was going to go cross margin, I want to make sure this stays open. I'd put like 10 times the amount of it or 5 times the amount of it. But again, I'm not doing cross margin, so that's why these are all 0. But yeah, that's kind of the basics, the first bit, and then I will go more into the other stuff next time. Oh, here, before I end it though, these are important as well. Liquidation price is the price that you run out of money and it closes your position. Order value, like if you go into Hyperliquid here, I'll show you. My liquidation price is currently 39. If it hits that price, this position closes and it's all gone. Even though from where I entered the trade, that is only 37% lower. Order value is just how much actual margin is in it. Oh wait, no, that's how much the position value is actually worth versus not how much margin. So since I put 5x leverage, this isn't correct because I split it between multiple trades. But if you put $100 on 2x leverage, your order value will be 200. The margin required to hit that order will be 100. Then slippage, the max movement a thing can move. So you click market, you click enter price. Then from when it actually enters the price, from when you clicked it to where it actually enters the price, how much can move. When you're trading bigger assets, it doesn't really move that fast, but max 8%, which is not ideal. But I only trade bigger assets, so it's not something I usually worry about. And then fees, usually pretty small. Yeah, and then you just get discount on fees, which discounted by the amount of volume you trade and referrals. So I'll create a referral code real quick. We'll call it River. Can we create that? No, we'll call it River USD. Create. All right. So you want 10% discounts on your fees or 4% discounts? Use River USD. But yeah, that's kind of the gist of the first bit of the trading page. That's the end of the video. Thanks for watching.